that avoided the automatic spending cuts and tax increases that would have been brought on if we had gone over the so-called fiscal cliff. However, not all the results are positive for the business community or individual taxpayers. Luckily, we have Mike Coppell, who has been following the ups and downs of the tax landscape for over 30 years and has been right on top of the fiscal cliff's negotiations from the start. Mike's expertise in the arena, coupled with Gregory & Gray's 65 years of experience in the energy field, makes the information we are presenting today essential for your business. At this point, I'd like to hand it off to my partner, Mike Coppell.
Okay. The first slide that you see is kind of interesting. Well, let me give you a little bit of my rules first. Those of you that know me know that I try very, very hard as a presenter not to be political. So that, you know, if you ask questions and they're political, that's fine. You can do it if you want. My position is I will try very hard not to be political. Number two is that I think it's very important that you get all of your questions answered. So as we go on, if you have questions, type them in. This sounds terrible and whatever. If they're relevant, I will answer them right then and there, or I may ignore them because I know I answer them later on or whatever. But if it comes up and it's a relevant question, I will read the question so that everyone understands what it is. The first slide that you're looking at is kind of interesting, where we talk about the good and the bad. And I was talking to some people, some friends of mine from around the country last evening, and we agreed that some of the things that you think are good are actually not so good, and some of the things that you think are bad are actually not so bad. And we'll talk about that specifically as we move on. So, why is my advance not advancing here? There's a picture of Jeff. He is obviously young and handsome. And there's a picture of me, and I am obviously old and not so handsome. And basically what you have there is you can reach me either by calling our office number, calling my direct line. A lot of people have my cell phone number so that you can call that should you want. I try and get to that. And there is my office email, which is my preferred way for you getting a hold of me. So let's talk about the American Taxpayer Relief Act of 2012 and whether or not it actually provides middle-class taxpayers, which is what this was designed to provide relief for, whether or not that actually happens. Now, one of the things that I've added this slide to all of the presentations that I've done the last 4 or 5 months because I think it's really important that people remember something. I'm a tax nerd. That's what I do. But one of the things that I was taught long, long ago, 40 years ago, is never let the tax tail wag the economic dog. And what that means is you're all businessmen, we're all businessmen. We have to understand that we have to take the economics of a transaction, what we are doing first, and then talk about the tax consequences and whether they help or don't help. And don't do something just for tax purposes because from my experience, when you do something and the only reason you're doing it is for a tax advantage, many, many times what winds up actually happening is that it's an economic bad move. So the first thing I want to do is that there have been some very interesting quotes that came out about this legislation. And just for fun and yucks, I thought I would read some of them. And the first one is, thanks for Congress for keeping its wayward members off the roads and out of the bars on New Year's. Second, and this is kind of interesting, the morning after, as so often happens, there are regrets. And those of you that have been following the news for the last 4 or 5 weeks, there are an awful lot of people that said, you know, there are things we wish we could have put in the bill, things we wish weren't in the bill. So I found this one interesting. Now, the most important one that I thought was interesting is one of the things that we hear about in discussion of taxes all the time and in discussion of what goes on in Congress all the time is something called earmarks, where something goes in and it's really designed just for a specific taxpayer or a very, very small group of taxpayers. And this quote which actually came from a friend of mine, I thought was incredibly insightful. Scanned the entire fiscal cliff bill for the best tax breaks. Algae and economic development for American Samoa. And I just found that really interesting, and I actually went back and found it, and there actually is a tax break for that, as well as some other rather obscure situations. Now, please remember that one of the things that was promised in this tax bill is that middle-income taxpayers, and I have no idea what a middle-income taxpayer is, but one thing that I do know is most middle-income taxpayers are working people. And what is interesting here is that the payroll tax holiday, the 2% reduction on payroll taxes that everyone has enjoyed for the last 2 years, went away. So that, for example, if you have a married couple with 2 children and both the husband and wife work and make $80,000, what this says is their taxes just went up by $1,600, which is really interesting, and we have to take into consideration as we move on and we talk about what's going to happen and who is actually going to save money and who isn't. Now, the biggest thing that the Democrats wanted is they wanted the rich, all right, to pay a higher tax rate. Now, one of the things that you're going to find is we have multiple definitions of rich. Those of you that attended some of our previous seminars know that back a while ago we talked about rich being a taxpayer, married filing joint taxpayer with adjusted gross income of $250,000 or a single person with $200,000, and that goes back to the increases that as were a result of what we call Obamacare, or I call PPACA. So that was what was one definition of rich. We now have a second definition of rich, and that is that a single person with an income of $400,000, and this is not adjusted gross income, this is taxable income. $400,000 single, $450,000 married filing joint are now going to have a new maximum tax rate. All right, so that's a new definition of rich. Now, if you noticed on the bottom of my slide, I have a funny little thing there of a man and a woman getting married with the not sign on it. One of the things that people said about this tax bill is that what it was designed to do is to eliminate the marriage penalty. As you look at this slide, one of the things you'll notice, and you'll notice with other slides as we move on, is there is a marriage penalty. So, for example, if you have 2 very successful people, a man that are both making $300,000, if they were single, they would not have to worry about a 39.6% tax bracket. Because they get married, their taxes actually go up, and they're now in the 39.6% tax bracket just because they got married. And that's something that is really interesting, and something that some people are talking about, because the marriage penalty concept, you will see, comes back in full force with this law. Now, capital gains and dividends, we all know that capital gains used to be 15% for the last 12 years. It now goes up to 20%. The same threshold comes into play as we talked about for the 39.6% tax bracket. Now, there's one other thing I want you to remember, and that is that based upon prior law, based upon the PPACA, based on Obamacare, capital gains and dividends, with a few exceptions, and if you have questions about it, you can call me or ask me what things that don't apply, have an additional 3.8% net investment income tax. So think about what this says. That means that starting in 2013, instead of having a 15% tax bracket on your capital gains and dividends, if you make over $400,000 or $450,000, all of a sudden what you can be talking about now is you can be talking about a 23.8% tax bracket. That's almost a 60% increase in the way capital gains and dividends are going to be taxed for those upper income people. Now, in 2012, if you had what's called an installment sale, if you sold something and you only got part of the money now and you're going to get part of the money in future years, and we have clients that have this situation, One of the things I want you to remember is you have the ability to do an installment sale and not recognize the taxable income, the capital gains, until you actually receive the money. There's a trap here. And the trap is that if you do installment sale treatment and come 2, 3, 5, 6 years from now when you're supposed to get additional money, if you don't get it, you're going to have a capital loss. Not an ordinary loss, a capital loss. And unfortunately, capital losses can only be used to offset capital gains or 3% a year. So one of the things that many people are recommending, and you should look at, but look at very, very carefully, is whether you want to specifically elect out of installment sale because it doesn't apply, because of the trap that you could have. One of the other interesting things is that if you have recapture, and let's talk about real estate for a second, if you had an investment in real estate and you sold the real estate, basically there's recapture rules on the depreciation you have, and that recapture is at 25%. So that what there used to be is a 10% differential between capital gain rates and recapture rates, because it was 15% and 25%. That differential is now down to 5%, and there is discussion going on in Congress whether or not to increase that recapture rate up to a higher rate, perhaps the 28% that is in place for certain other types of gains. So that's something we're going to be looking at and keeping track of very closely. Trusts and estates don't escape, and the reason this is important is that basically what we find is that if trusts have significant money, and that they have, in most trusts their revenue comes from interest, dividends, and so on, interest, dividends, and capital gains, the same rules are going to apply here, and they're going to apply at a much lower rate, so that somewhere around $11,500 of income, what you're going to wind up having is all of a sudden those trusts and or estates are going to be taxed at the higher 39.6 or the higher capital gains rates. So one of the things that we're talking about is you really have to be very, very careful if you have trusts and estates as part of your portfolio, that you're really going to have to take a look as we come close to the end of the year in planning what distributions you make out of trusts and estates in order to minimize taxes. And that's going to be a really complicated situation when you talk about things coming out and going to different areas, and what you may have for trusts for your children with kiddie tax and everything else. And that's something we'll talk about at great length at our year-end tax seminars next November. But it is something you have to be very aware of now. So trust planning comes into play. We have to make sure we understand it. There are a lot of trusts that were set up last year in order to take care of gift and estate purposes. So once again, that's something we have to pay very, very close attention to. Now, alternative minimum tax, which is the bane of our existence, and basically, especially in high tax states like Massachusetts, like New York, like California, like New Jersey, Vermont, for example, those are high tax states, and a lot of people in those states have alternative minimum tax. And one of the problems we've had with alternative minimum tax is when alternative minimum tax was first set up, they set it up and they gave a specific exemption for alternative minimum tax exemption, and they didn't index it for inflation. And what has happened is every year Congress gets together and says, yes, we have to index it for inflation to avoid having more and more people involved in alternative minimum tax. And what they finally recognized is that we have to do something, and one of the most expensive parts, one of the most costly parts of this legislation was making that indexing permanent. However, there is one other thing I want you to remember, and that is that non-refundable personal credits can be used for alternative minimum tax. Notice I put personal in capitals. What is important here, and we'll talk about some of the business credits later on, business credits used to be available to offset your alternative minimum tax. All of a sudden now, your general business credits, like R&D credit, which really you don't really have much of, but work opportunity credits that you may have and other credits, all of a sudden those are not going to be available for alternative minimum tax. I will tell you that there is a movement to have that changed perhaps even retroactively for 2012. That is something that we're keeping track of, and I'm actually going to be on a conference call regarding that next week. I don't hold out a lot of hope for it, but it is under consideration for some of the people. So if you have significant business credits, you should get a hold of me, and we should talk about whether or not those are going to be available for alternative minimum tax and how you can still be able to use those credits in the future. The PEASE limited itemized deduction phase out, we're now going to have another definition here of rich. In this case, rich is going to be married filing joint people, and once again, this is your adjusted gross income, not your taxable income, and single of 250. You'll notice that once again, we have a marriage penalty. So basically what we have is that your itemized deductions for certain of your itemized, for certain things are going to be phased out, and we'll talk about what the phase out is in a minute. But what I want to talk about is something that I found very interesting, and that is that not all itemized deductions are going to be available for phase out, only certain ones. So for example, medical expenses, investment interest, casualty losses, and my favorite, wagering losses are not subject to phase out. However, your state taxes, your mortgage interest, for example, and your charitable deductions are subject to phase out. So this is something that you really have to pay attention to as we're talking about this. Now, up to 80% of your itemized deductions can be phased out, and the phase out is 3% in excess of the cliff. So, for example, if you are married filing jointly and you have $1 million, and I use that number because it makes my math easy, if you have $1 million of adjusted gross income, all right, that means that you have $700,000 times 3%, or $21,000 of your itemized deductions you lose, all right, based upon what's there. And that again starts this year. Now, one of the other things that's kind of interesting here is that all of the items, all of the cliffs that we talked about when we talked about where the capital gains and dividend tax increases, when we talk about where the PEASE limitation is, when we talk about some of the other things. If you remember when we talked about alternative minimum tax, one of the things that we said is the importance of now making indexing automatic and permanent. What's interesting about this legislation is all of those amounts, none of them are indexed. So basically this is something where unless Congress comes in and makes these indexed in the future, what we're going to see is more and more and more people actually reaching these limitations as the amount people have for income and phase outs and income and so on goes forward. Long ago, it seems like long ago anyway, we used to talk about bunching and bunching your itemized deductions. We're talking about that again. So that basically what we have to do, and we'll talk about this at great length once again at our year-end seminars, is the importance of bunching your itemized deductions in order to maximize the amount of itemized deductions that you're actually going to get credit for because of the phase-outs. So that all of a sudden when we sit here and we talk, for example, about whether or not to pay your fourth quarter real estate taxes early, whether to make a payment early on your mortgage in order to get the interest deduction, all of those things we now have to look at again, because not only because we have to sit here and say, are we going to lose those deductions because of the PEASE limitation? And this is just one more thing that is going to come into play and make everything much more complicated as we go forward. Now, the other thing with the same level phase out is your personal exemptions are going to get phased out. And basically, you're going to have a 2% phase out for each $2,500, which just makes the math a little more complicated. But basically, what we're going to see is that anybody that has taxable income of something of our adjusted gross income, something slightly more than about $450,000, are going to lose all of their personal exemptions. Again, one of the things we're going to talk about, and we used to talk about, is whether or not it makes sense to try and see whether or not you can take your children and have your children use the exemption themselves rather than taking it on your tax return, since it's going to be phased out. And there are situations where we can do that and where we can't do that. That's obviously whether you can or can't do it is a subject for another discussion, one that we'll be having at the end of the year. But this, again, is something that we really have to pay attention to because those personal exemptions are going to be phased out at a relatively low income level. This isn't going to apply to a lot of people, but for those people that are involved, this is very, very important. The question of whether or not your IRA 401k should be in a traditional account, which means that you get a deduction for that amount now and you pay tax on it when you take out, or whether or not it should be in a Roth, which means you do not get a deduction now, but when you take the money out for retirement, you don't have to pay any tax on the amount you take out. One of the ways that they put this in to raise revenue is basically you can now at any age convert your traditional 401k to a Roth 401k, assuming that your plan sponsor, that your company, when they set up the 401k, set up a Roth option. For those of you that are involved in this, this may sound complicated. It's not. All you're doing is checking the box on your prototype plan. It is something you should talk about. Whether or not a traditional or a Roth is most effective for you is actually a fairly complicated calculation. I strongly recommend that you sit down with a really good financial planner. We are blessed at Gray Gray & Gray. We have Dan Romano, who is outstanding at this, who can really help you with this. You can give Danny, who is a long time friend of mine, and I trust completely. Give him a call, and he'll be happy to sit down with you. One of his people will sit down with you and figure out whether or not you're better off with a Roth or a traditional. This is something that it doesn't sound like much, but it can save you a tremendous amount of money depending upon which one you have. All the education opportunities are still there. They've been extended basically for extended periods of time. I don't want to get into them in detail. If you have any questions about them, give me a call, send me an email, and we'll talk about them at length. This was pretty much a given that this would happen. All the other individual things are back in play. There's the list of them that are really important. The one thing I do want to caution people is the last one. The IRS has been coming down very hard on people that make donations of real property, of real estate for conservation purposes and based upon that valuation. If you're planning on doing that, if you're planning on giving an easement of land for a conservation, if you're planning on doing a donation of a facade to a historical presence, especially that one, the IRS is absolutely brutal on what they're doing. Please talk to us before you do it and make sure that we think it's something that makes sense and is viable. You can see my little cartoon here on the side of surprise. This took all of us by surprise, and basically the first thing that happened is that the $5 million exclusion for gift, estate, and generation skipping stayed in place, which absolutely shocked almost all of us. Not only did the $5 million stay in place, it was also retroactively indexed so that in 2013 you have a gift, estate, or generation skipping exclusion of $5.25 million up from last year. That surprised us a great deal. Portability and portability is extraordinarily expensive. Extraordinarily important. So that let's take, for example, the magnificent Tina and I, and we don't have this kind of money, but let's suppose that we did, and let's suppose that I'm off skiing this afternoon, and I get, well, I was going to say get eaten by a bear, but all the bears are hibernating. I get attacked by a moose and die, And basically what portability says is that any unused exemption that I would have had basically now goes to Tina. So that means that Tina, when she dies, since we haven't made any taxable gifts, she would have over a $10 million estate tax exclusion, which means we now can sit here and say with some level of certainty that the vast majority of estates aren't going to have estate tax. Now, I want to call to your attention the last bullet. Depending upon where you are, and I know that a lot of you are in Massachusetts, one of the things you have to remember is that we have a much lower exemption in Massachusetts and a lot of other states, such as New York, for example, in California, where our son and his fiance are. Basically, in Massachusetts, you only have a state exemption of $1 million, and there is no portability. So if we go back and we talk about what would have happened if I should die, Tina has a $10 million exemption for estate tax, there would be no estate tax. However, if we had a $10 million estate, all of a sudden we could be talking about hundreds of thousands of dollars in Massachusetts estate tax, because Massachusetts, like a majority of the states, all but 5, have no gift tax, but they do have an estate tax. So even though we're talking about you may not have to worry about making gifts for federal estate purposes, it is very, very much an issue where we have to talk about gifting in the vast majority of states because of their estate or inheritance tax. And that is something, once again, you really have to sit down with a really good planner, sit down with my friend Dan Romano, give me a call to whoever, and we've got to make sure that we minimize that state estate tax because it can be an awful lot of money. Excuse me. You all know Section 179. It is a term we use all the time. It basically says that this is the amount of assets that you purchase that can be immediately expensed. What was a little surprising here is that the legislation retroactively extended the $500,000 you can immediately expense and the $2 million when the phase-out starts. This is surprising because we stop and think about it a minute. What legislation was trying to do, what 179 is designed to do, in a minute when we talk about bonus depreciation, these are designed to have people buy product and put them in place in order to stimulate the economy. Think about what it says. This was done retroactively to 2012. Anything you already bought is already happened, so that basically we were surprised this happened. The other thing you have to notice in this situation, as well as in bonus depreciation, is that this is only effective for 2012 and 2013, which means we have to pay a lot of attention later in the year to see whether or not this is going to be extended or not. And there are a lot of groups that are already starting to lobby to make sure, I shouldn't use the word lobby, that's a nasty word, but are already trying to talk to their Congress people in order to try and have 179 and bonus depreciation extended so that we can plan. Planning is something that we talk about in the business world all the time. And when we have legislation like this that basically puts and says you can only have this benefit for this very limited amount of time, it really affects what we as business people can do with our plans. Bonus depreciation, once again, the 100% bonus depreciation that we had in 2011 is gone. We have 50% bonus depreciation in 2012, and that's available again only through 2013. And that is something that we are working on to try and get that extended as early as possible in order to make business planning as good as possible. Business credits. Again, these are business credits, and I don't want to talk about the two most common ones. I don't know how much they affect you, but R&D credit and work opportunity credits are both retroactive. But remember what I said early on. If you're in a high income tax state like Massachusetts, all of a sudden these credits are not available for alternative minimum tax. There is a very, very slight chance that this will be changed in the next couple of weeks. We have people that are working on that and talking to people about that. But as of now, when you're doing your 2012 tax returns, these credits are not going to be available to offset your alternative minimum tax, which is really a major issue for a lot of people, because most small businesses, most closely held businesses function as pass-through entities, which means that you're an LLC, taxed as a partnership, you're an S-corp. So all of a sudden you have that income passing through that is going to be taxed at ordinary income rates or alternative minimum tax rates, but the credits that were earned in the business are not going to be able to use to offset your alternative minimum tax, and that's a pretty major situation for a lot of people. Tax. I want to make sure everyone is fully aware that we have major tax situations. A couple other things I want to make people aware of. I want to go back to PPACA, Obamacare planning. NII, which is net investment income. It is very, very important here that you understand that we are waiting for regulations. A lot of organizations, including the AICPA, and I helped make the comments, the AICPA comments for those regulations, are waiting for these final regulations to see what is going to happen. The regulations are very, very long, very, very complicated, and when we finally see how they come down, we'll talk about them in detail. There's another thing I want to talk about, and NII is 3.8%, and which is very, very significant. The other thing I want to talk about is the tax on earned income. And what I want to talk about is this is only 0.9%, only 0.9% increase in tax on the individual. Anytime you have 0.9%, it's not huge, but it's significant. So let's suppose, for example, that you are a shareholder employee of an S corporation, and you have salary of $1 million. Right? Basically, so what happens here is that the difference between $250,000, assuming you're married, filing joint, and the $1 million, and $250,000 and the $1 million, that differential, and I apologize, I don't have a calculator here, but you can figure it out, has an additional 0.9% tax on it. What we are recommending to people, where we're talking to people, is that you should be absolutely doing a detailed decision as to how much you actually want to have for S-corp wages. I will tell you the IRS is becoming increasingly aggressive in challenging whether or not wages are sufficient or not. And basically, in the old days, prior to this law, what they used to do is they used to sit down and say, okay, you know, they would only look at very, very low wages and say they're too low. They're now also going to start looking, and we've been told they're going to start looking at people with slightly higher wages, especially people where there is significant business income left in the entity. So let's take an example, and you know, let's take an extreme example. Let's suppose that we have an S corporation, and the S corporation taxable income is $4 million, and the wages to the shareholder employees are only $1 million. $1 million is a lot of money. The IRS is going to come in here and say, wait a minute, is that high enough? Because there's $4 million, 4 times as much left there, which is avoiding the 0.9%. And we've already been told the IRS is going to do that. The other thing I want to do is talk about LLCs for a minute. A lot of you that know me know we've been talking about a concept called bifurcation for 12 or 13 years. And what we do in bifurcation is we set up the LLC in such a way to minimize the self-employment income. We've defended that. I've defended that numerous times in the last 10 years without problems. If you have an LLC that you're operating in and you haven't been talked about and you haven't dealt with something called bifurcation in order to minimize self-employment tax, give me a call and I'll be happy to sit down and explain to you exactly what bifurcation does, how it works, why it works, It's pretty straightforward. It doesn't take a whole lot of planning. I hope there aren't any attorneys on the phone. The attorneys aren't going to get a whole lot of billing out of amending the LLC operating agreements. We have some pretty standard verbiage that we can recommend to them. Last thing I want to talk about with PCACA and Obamacare is that, as anybody that is involved in talking about the healthcare portion of this knows, there are certain tests that come into play, and the first test that comes into play is whether or not you have 50 full-time equivalent employees. And basically the question here is, when do you start counting? And the regulations say that you could start counting retroactively. So that basically it says that in order to count the 50 full-time equivalent employees, you could start that basically this year, or you can do it prospectively starting next year. And you really have to sit down and talk about what is best for you, what makes most sense for your organization, how quickly you're growing or not growing, and when to do it. We are currently planning, and if you're not on our mailing list, please go to our website, sign up for our mailing list. We are currently planning to bring in experts in this field who will be talking about this at length, and we'll be doing that sometime later in the winter or early spring. Whoever that person is, you absolutely want to make sure that you attend that seminar to discuss all of these things with the experts we bring in to talk about it. The repair regs, I want to talk about this because a lot of you people, in addition to having operations, you also own your real estate. And there are some things that we should talk about. In a few cases, and I don't want to get too specific here, but in a few cases, especially if, for example, you own your own real estate and you made significant improvements or repairs to your real estate in the last 3 or 4 years, something that you should be talking about with us or your other tax advisors is early adoption of the repair regs in order to go back and actually see that you can actually expense a lot more than was previously expensed. The new repair regs will be effective in 2014. Final regs we expect to be out sometime probably late in the second quarter of this year. They're extremely complicated, and I can almost guarantee you that it is going to affect almost every significant taxpayer out there. When the final regs come out, we will do some webinars regarding them. It will change the way you capitalize repairs to your trucks, to your buildings, to your structures, to everything else. It is going to change things very significantly. One last area that I want to mention, and I mention it for 2 reasons. Reason number 1 is the IRS and the Department of Labor, the Internal Revenue Service, and the DOL, have both indicated that worker classification, whether or not a worker is considered to be an employee or an independent contractor, is a major, major issue with regard to both the worker's proper classification and what they're entitled to, and as well as what happens with them going forward with health care. Now, just for yucks and fun, I will tell you that there was a very interesting, and it's just for fun, a very interesting case in this area, and I apologize in advance for using this type of worker, but there was a recent case involving strippers. All right. And basically, I guess that, and I know I do not frequent those establishments, but there was a recent case where basically strippers said that because of the club told them what to perform and when to perform and what they could and could not do on stage, they should be considered as employees and not independent contractors. And the reason they did it had nothing to do with fringe benefits, which we see all the time, nothing to do with payroll taxes, which we see all the time. In this case, the club had closed. And what the strippers wanted is they wanted to collect unemployment insurance. And they actually won that case. So that basically, in addition to everything else we talk about in worker classification, where we talk about that payroll taxes should be paid, that we talk about fringe benefits, potentially including health insurance, retirement plans, and everything else, I found this to be interesting just because I had never seen before a situation where it was done in order to collect unemployment insurance. But basically, the IRS and the DOL are going to be looking at this extremely, extremely hard. Why do I bring it up now? The IRS and the DOL basically have a semi-amnesty program currently in place, which expires the end of June. If you have a situation where you think that you have a worker that may be misclassified, I strongly recommend that you get in touch with us, you get in touch with an employment expert, and talk about this. The consequences can be very, very severe, and they can be severe not only for the business, but because payroll taxes may be involved. Basically, it can also come right back, and if payroll taxes were not paid on these people, the payroll taxes can be assessed not only against the business, but also against what's called a responsible person. And a responsible person is anyone who has the authority to designate payment, to sign checks, and so on. So that if you misclassified a worker, they can not only go after your business, they can go after you. And like I said, there is a semi-amnesty program in place through the end of June. We think it's going to be extended, but that's basically where we currently are. You're all aware that there's a lot more to come. Basically, that right now everyone is talking about the sequestration, the debt that's going on, that's going to happen. Later on in March, we have the debt ceiling discussion coming on. I don't know what the president is going to say last night. I was kidding with the lovely Tina last night that I was reading something on a web page where some of the Democrats in Congress were already talking about a rebuttal against what was going to be presented by the Democrats were already rebutting what the Republicans were saying without even knowing what the Republicans were going to say, based upon what the president was going to say in his State of the Union without actually knowing what the president was going to say in the State of the Union. But basically, the battle lines are being drawn with regard to increase in taxes. Yes, the increases in taxes have not stopped. There are a bunch of things that are on the table that can affect just about anybody, as opposed to cutting spending. And an awful lot of what they talk about in cutting spending is entitlement plans. But we don't know what's going to happen. But sometime in the next 45 to 60 days, we could see some very, very significant changes in tax law. And if that does indeed happen, we'll talk about it, and we'll have more webinars and seminars to talk about what's going to happen in that area. I have one last comment, and please remember that I've been doing this for a lot of years. And what I want you to remember is that in tax, the definition of permanent is only until Congress changes it. So when we sit here and talk about some of the things that we talked about and say that these are in place, for example, the gift and estate exclusion of $5 million, which is indexed forever, and we say that that is in place permanently, remember, permanent is only until Congress changes it. And basically, we have a lot going on. We know we have some significant things that are happening, so that we have that going on. I haven't seen any questions. Does anybody have any questions that they want to type in? I recognize typing this stuff in is a pain in the ass, as opposed to be actually saying it. Just let me see if I can. Okay, I don't see a thing here that lets me unmute all. So are there any questions? Okay, if there aren't any questions, I want to thank all of you for coming to this. Once again, the easiest way to get a hold of me is through email. But you can call my office, call my direct line. I do check that regularly. There's a lot going on. Taxes is going to change, and unfortunately, one of the things that we have found here is successful, closely held business people are clearly in the crosshairs of what's going to happen. So if there are no further questions, I don't know if Jeff or Joe, if you have anything you want to add.
No, Mike.
Okay.
Thank you very much.
Okay. I want to thank all of you for attending, and if you have any questions, feel free to contact me. Thank you.